Hey there, Singaporean investors. If you're keenly interested in Soilbuild Construction Group and you're wondering whether to buy more of the stock, or perhaps even consider selling it right now, you are absolutely in the right place. I'm Iggy from the Investing Iguana, and in this video, I will provide you with a candid, balanced breakdown, focusing on 3 compelling good points that make this stock attractive, and then, just as crucially, 3 significant bad points or red flags you absolutely need to be aware of. And make sure to stick with me all the way to the end, because in the final segment, I will give you my personal investment advice on whether to buy, sell, or hold this particular stock for your portfolio. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, content is literally all I do. I also focus on regional and global economic trends, giving you that broader context. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore market, you'll want to hear this. Let's kick things off with the positives. For Soilbuild Construction, one of the most compelling strengths we've identified is its absolutely massive and record-breaking order book. Think about it. This company is sitting on 1.21 billion in confirmed projects, which gives them incredible revenue visibility for the next few years. We've seen this play out in its latest financials, showing a staggering 263% explosion in net profit for FY 2024. This huge backlog, which includes their largest ever 647.5 million contract for the PSA supply chain hub, is like a restaurant being fully booked for the next 2 years solid. You know the cash is going to come in. This dominant position provides a strong foundation, but is it enough to guarantee future success? Moving on to our second good point, Soilbuild is perfectly aligned with Singapore's future infrastructure boom. For many Singaporean investors, finding companies that grow with the nation is key, and Soilbuild is right in the sweet spot. They are poised to benefit from mega projects like Changi Airport Terminal 5 and the massive BTO housing program. What's more, they specialize in the high-tech green buildings that Singapore is actively promoting. It's certainly a comforting thought in today's volatile market, isn't it? And finally, the third positive aspect worth highlighting for Soilbuild Construction is its technological and green building moat. It's not just about what a company is doing now, but what it's planning for tomorrow. This company has strategically invested in technologies like building information modeling, BIM, and AI-powered site monitoring to boost efficiency and safety. Their decade-plus head start in green construction was a key reason they won the massive PSA contract. This is like having the latest smartphone. When your competitors are still using flip phones, it gives them a real edge in winning the next generation of contracts. Are these ambitious plans truly achievable, or are they just on paper? We'll dig deeper into that. Now let's turn our attention to the flip side. The 3 critical red flags you need to consider before making any investment decisions on Soilbuild Construction. The first significant concern is its debt load. While growth is good, excessive debt can be a serious burden. Their latest balance sheet reveals approximately 59.9 million in debt as of December 2024. This could impact its ability to fund future expansions without further borrowing, or even affect its dividend sustainability if interest rates continue to climb. A key concern for income-focused investors here in Singapore. How much debt is too much, and at what point does it become a real threat to shareholder value? Our second red flag is the cyclical nature of the industry and intensifying competition. Even dominant players aren't immune to market cycles. The construction industry is famously boom and bust, and Soilbuild faces stiff competition from well-capitalized local and international firms looking for a piece of Singapore's infrastructure pie. This increased competition could erode its market share and put pressure on its profit margins in the coming quarters. It's a classic case of Goliath versus a fleet of Davids. Will the incumbent be able to adapt quickly enough? For even more granular data, in-depth charts, and a full written breakdown of Soilbuild Construction's financials and strategic outlook, make sure to check out our Substack. The link is right there in the description. Finally, the third major concern for Soilbuild Construction is its heavy reliance on government projects and macro headwinds. Diversification isn't just for portfolios, it's vital for a company's revenue streams. A large part of their current boom is tied to public sector spending. This makes it vulnerable to shifts in government policy or budget constraints down the road. Furthermore, rising material costs and persistent labor shortages across Singapore could squeeze their profitability unexpectedly. What happens if steel prices spike or a new government policy shifts focus away from big infrastructure? These are the questions that keep seasoned investors up at night. All right, we've weighed the good against the bad for Soilbuild Construction. We've looked at its massive order book, its alignment with Singapore's future, and its tech-driven competitive moat. But we've also squarely faced the challenges: the rising debt, the intense competition, and the macro risks. So, what's my overall assessment for Soilbuild Construction? This is a company with a strong 50-year legacy and a fantastic growth story, but it's operating in a tough industry that demands caution. Considering all these factors, my personal rating for Soilbuild Construction is a buy. My clear justification for this is that the monumental $1.21 billion order book provides a powerful safety net against near-term uncertainty. The company's valuation at just over 5 times trailing earnings seems incredibly low for a company that grew its profits by 263%. While the risks of debt and competition are real, I believe they are more than factored into the current share price, making this a classic contrarian opportunity. For Singaporean investors, my strategic advice is this: if you have a moderate to high risk appetite and a 2-3 year investment horizon, Soilbuild presents a compelling opportunity to invest directly in Singapore's growth story. For those looking to initiate a new position, the current valuation offers an attractive entry point. Is it a good fit for your CPF portfolio? Potentially, but I would classify it as a satellite holding rather than a core one, given the industry's cyclical nature. It's suitable if you have a long investment horizon and can tolerate the potential volatility. So, we've broken down Soilbuild Construction piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. If you found this level of in-depth, actionable analysis truly valuable, please give this video a like, share it with fellow investors, and subscribe to the Investing Iguana channel so you don't miss our future deep dives. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.